Welcome to the MHP Exchange, where the riches are in the niches. We'll show you how to invest your way into mobile home parks with real strategies, tips, and behind-the-scenes know-how to grow your cash flow. Stick around. This is where smart investing begins.
Welcome back to another episode of the MHP Exchange podcast. I'm Frank Rizzo, and today we're going to do something a little different because over the last 7 or 8 years, through the countless conferences that I've gone to and the hundreds, maybe even thousands of investors that I've spoken to in the space, whether they're starting out or they're early adapter investors, we get this. I've heard the same message repeated consistently on what they're looking for. It's direct bill, public utilities, water and sewer. It's paved roads. It's MSAs with 100,000 or better. And it's parks that are 50 units or better. And that's not accidental. That is what we've been told, or the industry's been told, that the institutions want or the lenders want. But in doing so, with everybody looking for the same thing, there is a case to be made for small parks. I'm not talking micro parks. I'm not talking 5 units or 7 units. I'm talking for parks between 20 to 50 lots. There is a case to be made for that. And today, we're going to debate that point. And we brought on our CFO, Pete Falcone. If you're a listener to the program, you know he's a partner of ours. And I'm going to give you you're going to see some of the back stage or back room of some of the internal debates that a real estate company has and how to deploy capital. And as we discuss this, and Pete is a big park guy. Pete, welcome back to the program. How are you today?
Yeah, doing great.
All right. So for those of you that are listening, Pete, we're talking about you prefer big parks. I mean, it's not even a question of preference. I mean, you're pretty adamant that big parks are the way to go. I mean, what is your number one reason why to focus on that?
I mean, it's relatively straightforward. You have your administrative scalability. You have your operational scalability. It's just in terms of a company that is scaling and growing, to make the same effort to run a smaller park versus a large park, it's just doesn't make that much sense.
But here's what's happened, right? If you look at what has happened in the space over the last 5 years specifically, I mean, there's a tremendous amount of capital that's poured into the space from private equity. They're all chasing the same thing, right? With Brookfield making that $10 billion play for Yes Communities, for them to move the needle, they can't pick up a 30-unit park, right? They need to get that 100, 200 unit, 300 unit park for that scale for that number to make. But doesn't that leave that under 50 unit park, doesn't that leave a huge opening for the individual investor to be able to find some real value there?
I mean, maybe a little bit, but I think you're just trying to take the pity side for smaller parks. When it comes to so let me give you a perfect example when it comes to scalability. You go to an MSA, any MSA in the country, and let's say the average salary for a park manager is $52,000. Just easy numbers. Where are you more likely to be able to support that payroll? Larger park or smaller park?
Larger park.
Right. So how do you support it with smaller parks?
I think that's a great point you made. That's a great point. But I also think if people live in a smaller park, there's a different set of expectations, right? So if you're in a 30-unit park, to have a full-time manager doesn't pay. Right? Because to your point, you're not going to be able to make those numbers work to have a full-time professional manager to be able to drive that. But I think some of the culture and the ethos that happens down on the ground when you're in that smaller community, the expectations of that resident could be a little bit different. You can't manage it exactly the same. And so that's a little bit of a trade-off for there.
Right. You might have a different resident base. You might have a different culture for the community, for lack of better words. Maybe it feels cozier in a smaller community. But with the larger communities, with scale, right, you reduce your fixed cost per unit, right? It's much easier to justify buying a larger community, even if it's 30% occupied day one. If you're still paying $1,000 a month, for example, for software, well, what's easier to support? A larger community. When you have a larger community, you also have the ability to change the culture more with what you're doing there. So, for example, you buy a 100-unit park, you have the ability and more likely to have the space for, let's say, amenities. You want to put in a pool, you want to put in a playground. That's the benefit of a large park, or one of the benefits.
Yeah, but aren't you for the larger parks with that competition? Aren't you paying more for that park? Like, you're going to pay a premium in that larger park.
Yeah, we could pay a premium, and it really depends on, I guess, is it on the market? Is it off the market? I mean, there's a lot of variables to that. Yeah. When you're buying the larger parks, it also creates the ability to finance it better. So when you have a smaller park, your lenders are very limited. When you have a larger park, you are more likely to get financing from just about anybody, and your options are more available, right? So you can go for agency financing, you can go for CMBS financing, you can go for bank financing. The economics of loans are better with larger parks. And that's statistically true.
So I'm going to agree with you on that notion, right? But here's my counter argument to that. The seller of the smaller park knows that. So when I'm having the conversation with that seller of a smaller park, they know that, hey, I don't have as many options. Like, I need to have a relationship with a local community bank to get this financed, right? This is not something that, unless you have a great relationship with, community banks or regional banks, most lenders are going to probably scoff at, underwriting a 31-unit park in Jacksonville, Alabama, right? Because they're not familiar with the market, they're not familiar with the collateral. So you either have to have a strong local presence, or B, number two, that becomes my leverage to negotiate with the seller to get a better seller financing package, right? Mm-hmm. So perfect example, the first community that we purchased was a 31-unit park in Jacksonville, Alabama. And, while we were real estate experienced, we didn't have a lot of history or book of business in the manufactured housing space. And while we initially said, hey, we're going to go get bank financing, we realized that no lender would finance us. And what it allowed us to do was to go back to the seller and say, hey, if you want us to buy this property, here's what we need to do. You're going to have to offer somebody financing, right? It might as well be us, because we do have a track record of performance. But here's the terms we need to make it work. And sometimes when it gave us a little bit more ability to negotiate direct with the seller, not just for price, but for terms. And I don't know if you always have that ability in the larger parks. Like, sometimes you do, right? Not that you don't ask for, but I don't know if that ability to negotiate directly with the seller, not on price, but on terms, is as strong in a bigger park as it may be in a smaller park.
Which is fair. And I don't think that you're wrong on that, because the larger communities are more likely to...
Wait. Did you say I'm not wrong on that?
On your point, okay. But I think mine still prevails.
I every time Pete tells me that I'm right or that he's wrong, I put it in my calendar as a reminder, and I remind them on the anniversary. So go on.
Yeah, I mean, that's okay. I think we're probably at 2 incidents where you were correct. So on the structure, yes, right? But what do you do after that, right? So is the guy going to give you, or woman going to give you 5-10 year financing? What happens after the 5 or 10 years is up? You have to go to a bank, to your point. But then you're still doing the same effort for a smaller park versus a larger park, right? So in your example, you're still going to Jacksonville, Alabama from New York, and it's incurring costs. So let's say that trip costs you $1,500. Well, your 31 unit park that was the first purchase is eating that cost on a higher per unit basis. Whereas if you had a 100 unit park, it's de minimis.
Okay. So that goes, that plays into the operational scalability of that, right? And you've mentioned that, hey, I could, on a larger park, you definitely have more room for error or to absorb some cost. But on those smaller parks, like if you're going to sit in that 20 to 50 unit range, right? If you're going to sit in that 20 to 50 lot range, you have to have some parameters to understand that you're going to have to operate that in a slimmed down version of what you might want to do at your larger communities. And to your point before, you're not going to look for amenities to drive value in a 30 unit park, right? Your value proposition is going to be completely different than maybe putting in a pool or a playground or whatever the case may be. It is going to be more focused on how can I run that efficiently, right? I don't need a full-time manager. Maybe I need somebody to oversee that park, right? And to view that park and kind of give me an update along the way. I think that's key to being successful in that. And you have to really take a look at where you could drive down costs. I would say if you're buying a smaller, 20 to 50 unit park, one thing that I would absolutely not do is look for 30 to 40 park-owned homes. I think that would be a recipe for disaster.
Oh, yeah, easily.
Right.
And but to your point, like, let's say there's, park-owned homes in general, right? And I'm not saying 30 to 40 park-owned homes, but...
Well, I'm saying in a park that's smaller and all of a sudden you have, 90%, 80 to 90% concentration in park-owned homes. I think that might be, initially it might look great, but I think longer term, you can have some real issues to the bottom line, right?
Of course. And so let's say, you have 10 park-owned homes in a 30-unit park, you're more at risk to vacancies. So it's a larger financial impact to the community. And when you're doing that, it limits your ability to, A, collect profits, but B, also cover your costs, right? So if you're going to have to put in more effort and more concentration to lease up those vacant units in the smaller park.
Yeah, and I think that's a great point, because if you don't have a manager there that's on site, and we're having this conversation as if this isn't local and you're not self-managing it. So I think there's a couple of different variables which really make this space so interesting, because there are these different variables that happen inside the same deal for different people. But if you have the higher concentrations of park-owned homes in a smaller community, I think that it does become it can be a little challenging leasing up. I'm more on the sales side. I think that can be mitigated. My bigger concern may be, how does that repair and maintenance line on my income statement look if all of a sudden I have to do significant unit turns or repairs and I don't have somebody physically on site and conducting inspections and doing all the things that you normally would be able to do in a larger park. I think that's something, if you're looking at a smaller park, you'd have to mitigate out. Hey, if there's a high concentration of park-owned homes, how do I dispose of some of those homes quickly, whether I sell them off to the residents, whether I discount them, and put people on a pathway to home ownership. And then maybe I have some park-owned homes, but I have the newer models that maybe will be less maintenance over time.
Right. But to your point about cost and maintenance, so when you have a smaller community, you're going to have to reserve higher amounts. And the reason being is because if you have a cost that you can't cover, what are you going to do? You're going to have to go for financing or borrow like money somehow to cover your cost. And so let's say you have a new septic system. What is that going to cost? $6-7 grand to replace? Is that 2 months of profits, in a smaller community? Or is that a month of profits? Where if you have a 100-unit community, it's a blip in the radar.
Yeah. But so some of the challenges, though, Pete, that I see today, and this is the conversation that we have regarding the market of how things are happening currently. I mean, when we first started buying these communities, you could buy a larger community that was discounted with some value add, but was already yielding a pretty nice cash flow. The challenge today is when you're not getting all three of them because there's so much competition for those larger scale parks, right? They're just, especially if you're in a stronger MSA, I mean, there's tons of competition out there. So that's driving down, that's compressing that yield day one. But in these 20 to 50 unit parks, sometimes with the less competition, maybe it's not about value creation. If it's about cash flow, there is different day one cash flow. So if you're ultimately looking at, hey, how do I get that current yield without having to drive that value, right? In terms of making sure that, we're running this as a 5-star community, right? Or as close to a 5-star as possible. I can step into pretty decent asset with high yield cash flow day one. And now I'm getting, I'm in the space and I'm creating that cash flow. I mean, what are your thoughts on that? Like, positioning for an investor stepping in day one.
So first point is I'm enjoying watching you sweat while I'm clearly just having a better argument, I should say. But yeah, you might have better day one cash flow, but at the end of the day, you're bringing up a great point, right? Your yields are higher with a smaller community, but that's on the buy side. What about the sell side? How do you exit?
So and that's an interesting point, because I think you have to look at if you're building a portfolio or you're buying one park. Let's say if you're buying one park, and if you're buying one park and you're looking at it for cash flow, you can't look at that exit, even though you have to pay attention to the exit, but you have to look at what's more important to you. If I want that day one cash flow, here's my yield. I know when I'm going to exit that property, I've got to offer probably a similar yield, maybe a little bit better. So what can I do to increase that income during the time of ownership? Am I guiding rents upwards? Probably slower than in a bigger park, right? Because you want to make sure that you're maintaining that resident base and you're not driving value through amenities or different options. So you have to be conscious of that and be conscious of the fact that, hey, maybe when you sell the same way you acquired it, if it was with seller financing or if it was taking a little bit more time to be on the market, you have to be comfortable with that day one. You have to understand, hey, if I own a solo park that's 20 to 50 units, I might not sell it as quick unless I discount it, and I might have to ensure that that I'm providing that cash flow. I mean, we've had some success in smaller parks in certain markets, but I mean, that's a point you bring up. Like, you have to have that end in mind and not think that, hey, I'm going to buy this at an 8 cap and someone's going to take it from me at a 5, right? Right. So you touched on amenities and value drivers there. What do you think? Where do you think that positions the big parks over the smaller parks? Like, where do you think why that's better for the bigger park? I mean, is it all just about driving amenities and bringing rents up through driving value that way?
I mean, it's part of it, but I think the biggest part is attraction and sales of your homes, right? Your infill, your resident base, you create a better culture. Ultimately, when you have a nice book of amenities, which, for the record, has been a trend in real estate for a while and continues to be a trend, but especially, I mean,
Well, people, I don't care who it is, people want the experience, right? It's always about the resident experience or the consumer experience. You're not selling four walls. You're offering the experience of living in this community. So to that point.
right. And it's an aspect of where are you more likely to sell a home or where are you more likely to infill? A community with amenities.
So I think that goes back to the point of amenities don't always have to be physical, right? It could be cultural. And how do you instill a culture in a smaller community if you don't have a full-time manager? Now it can be done.
Yeah,
but
you could put a campfire in the middle and sing Kumbaya.
But there's ways that you could do it. But I think to drive down the course, you have to be willing, if you're buying one park, right? If your goal is, hey, I want to have one community and it's going to be in this, right? It's maybe more active ownership. And how am I going to instill culture, not just raise the standards, but, is it a community homepage? Is it getting everybody connected on maybe a Facebook group as to what's going on? Is there little things that I could do inside that community to get people to bond together? So because to your point, it is a little bit more challenging infilling, bringing in a new home in a smaller community and then selling that home to somebody, unless you have, real compelling value proposition. Maybe the lots sizes are bigger. Maybe it's a little quieter. But instilling that community, I think there's more. You have to be prepared if you're acquiring those size communities of a little bit more ownership involvement, right? So if you think it's going to be, hey, I'm going to buy it and do nothing, and somebody, I don't think that that's the way to do it. I think you have to look at it as as more of a way to. You've got to be actively involved in it.
Yeah, and you're going to have a more personal relationship with the residents, but I think that there's pros and cons to that. In most times, it's a pro, but sometimes, let's say you have your resident loses their job, you're more likely to let them off a little bit and maybe not take in revenue or give them a month or two to kind of get back on their feet without taking a role that with a larger community, it's like, listen, I'll work with you for a little bit, but you still owe the money, and at the end of the day, we just you're gonna have to go. And as you know, we always try and work with our residents, but it just, when you're at a more personal level, you're going to be more incentivized to let them almost take advantage of you.
Well, there's always a challenge when because at the end of the day, this business is not about bricks and sticks. It's always about people. And so the challenge is always, where do I draw that line, right? And having systems and processes in place where the system and the process can become the truth, and not necessarily my feeling on that day towards that person. That's super important. And I don't care if you have a 20-unit community or you have a 2,000 lots on the management. Having that is super important, because otherwise you're always going to be running things differently day to day, because your emotions change day to day. That's just a human. That's just a human element. So to that point, yeah, I think either way you need to have that structure in place. But I think overall, Pete, where you're seeing the market go right now, and I know there's only something like, depending on who you talk to and what day of the week, anywhere between 42 and 44,000 parks nationwide. And then as you break that 42 to 44,000 parks and you start looking at it, okay, where's the spread of them? Like, how many parks are 500 units or better? 1%, right? How many parks are 200 units or better? Maybe 3%. 100 units or better. The vast majority of parks sit in that 20 to 50 range, right? That is where you're going to find the biggest, meatiest way to go. Because on those larger parks, even though this is still predominantly mom and pop, a fractured industry, most of the institutional players are 100 lots a bit better, right? So now you're competing against people who have maybe deeper capital, right? Deeper pockets, deeper ability to get that. if you're going beyond one park, right? We spent some time talking about one park. If you're building a portfolio localized, right? I wouldn't want to spot buying a 20-unit communities all over, a region. I think that could drive you nuts. But if you were going to spot in a city, a county, a town, and say, okay, this is a market I want to be in, couldn't you get the same efficiencies from buying a bundle of smaller communities as you would buying one bigger one?
A little bit, but you're going to be running up the mileage on whoever's driving around between the communities. You still have to track different properties. And so, for example, let's say buy 10 communities in that county or that local region, you're going to have 10 tax bills, right? You're going to have 10 insurance policies, or at least 10 locations on one policy, one blanket policy. You're going to have 10 properties in your property management software. You're going to have, 10 locations that you have to focus on sales and on collections and, 10 entities. And so it's just administratively and operationally, it's just easier and more worth it to have large communities. For example, we go through diligence. We're doing the same diligence on a larger community as a smaller community. The only part that might take longer on a larger community is if it has more park-owned homes, more inspections of the homes. But outside of that, you're still going to the site a couple of times. You're still going through the P&L, the general ledgers, all that sort of. Your general ledger might be smaller, but what does that take? An extra 3 seconds to drop the formula down further on a ledger? Like, it's not. In my eyes, it's just not worth the time and energy spent to operate a portfolio of smaller communities. And sure, you might be more likely to get financing, but the lender's not going to want to deal with that on a smaller scale. They're making $1 million loan just for sample sizes. To make $1 million loan on one property is easier than 10 properties.
So it is, right? But one of the things that looking at other asset classes, like one of the things that always surprised me, and I remember back in 2007, 2008, when all of a sudden the institutional play for single family homes started to take shape, right? And I think it was Homes for America was the first company that came out there, and they were going to buy a portfolio of single family homes. And I was involved in property management with my real estate business. I had managed some duplexes, triplexes, and I in my head, I was like, I couldn't understand how they were going to do that, because to your point, like, they're going to drive around from resident to resident, and it's now, granted, they ended up going, into developments and buying tracts and developments, but then they buy something neighboring and they would do the same thing. And all of a sudden now institutional ownership has become a real problem in this country of single family homes, where last quarter, talking about fourth quarter of 2025, they were 27% of all single family home purchases, which is somewhat problematic, right? But the point is, they figured that out, right? The point I'm making with that is, I get what you're saying about the management of those smaller parks, but seeing that it was done with single family homes, which I thought was just mind-boggling that they would be able to do that, you think that ultimately by building that portfolio of smaller parks, if it's concentrated, right? If it's not, I'm not a fan of spotting, right? Go into a market, like that market, acquire in that market. If you spot across the board, you better have size, right? You better, because to do it for 20 units and to be on different coasts is just, I don't know how you would do it. Do you think at some point, though, like where the puck is going, that they will figure that out, that all of a sudden maybe those options may open up for you over the next 3, 4, 5 years? So it might become a little bit easier to find exit financing, might become a little easier to find different buyers for that pool?
There's a possibility. Anything's possible, but what are the odds? Probably very, very slim. It's more likely that the industry changes before people target the operational stress of smaller communities. And by industry changing, I mean manufactured housing becomes less of a black sheep to municipalities, local governments, and it's widely recognized as probably the most affordable version of a cost for residents, right? So it's the cheapest version to live, but also cost for operators. And what I mean by that is you're more likely to have incentives to build 100 affordable units of manufactured housing than you are to build 100 affordable units of apartments. And why is that? Because you can't build 100 affordable apartments in, let's say, one building for argument's sake, because the math doesn't math. It's going to cost you, for argument's sake, $10 million to build, 100 units of apartments, but your return might be like 3%. Where's that worth it? It's not. Unless the government steps in and provides crazy, tax incentives or maybe funding like a interest-free loan or whatever it is, the scalability of the incentives for an operator to come in and build 100 affordable units and to make lives in communities better on a manufactured housing community, I mean, the cost is astronomically cheaper. So they're more likely to do it because the yields are also higher with the cost being cheaper.
So ultimately, I think ultimately the debate for small park, large park, I think it goes back to what your vantage point is. What's your business plan? Are you a solo entrepreneur? Are you buying this park on your local? Are you willing to be hands-on? Do you have a business plan for that? And I think it definitely comes down to how much margin of error are you going to have? And to your point, on a larger park, you have a bigger margin of error because you can mitigate some of that cost. But in the smaller parks, you have to make sure you're right on, right? And that goes to understanding where your expenses might be, how to mitigate that, and run that park as efficiently as possible. But the real key, I look at it, is when you acquire some of these smaller parks, if you're looking at cash flow day one, you could find a lot of value. And I think the market is just not seeing right now in those smaller parks. I think you could find a lot of value in that if you're looking for immediate day one cash flow. They could be real coupon clippers for your portfolio if you can operate it right. Any last words on that?
I think I won.
Well, here's what we want. You've listened to this. We want to hear your comments on the debate. So click on whatever streaming platform below. Tell us large parks, small parks. And if you send that rating to the MHP Exchange.com on where you voted, what we're going to do is we're going to send you a copy of our after site visit report. That is the same report we use for our team when they go visit one of our assets to ensure that the team's aligned, that the business plan is being executed, and we know next steps. So if you're looking to build or scale your business, that's a very helpful form that we've found to find great value in it to help us execute our business plans. Pete, thanks for the conversation. This has been a great debate. Until next time, everyone, happy investing.